Welcome everybody to this morning's webinar. It's actually the 10th webinar in our series that's focused on, I guess, all aspects of running a business. And today we're here to talk about where to find funding and capital to grow and expand in 2021. We're joined by Tim Eisenhauer, who is the Managing Director, Distribution at On Market. So welcome, Tim. Thanks for joining us.
Thanks, Mark.
And also by Garry Pinch, Business Services Director at Accounting Professionals. Hello, Garry.
Yeah, Mark.
So yeah, as I said, we're going to talk today about how businesses can fund and use capital to grow and expand their business. And we might start off by asking you, Tim, what does On Market do? Can you explain a little bit about the business?
Yeah, thank you. And good morning to everyone that's joined. Easiest way to describe On Market for everyone is we are an investment platform. On the one side, we have companies wanting to raise capital. On the other side, we have a database, as you can see on that slide, there are 52,000 members who they don't pay anything to join the platform. They're just looking for early stage, innovative Australian companies. We've done, over the course of the last 4 years, roughly around 160 odd transactions. We'll get into this a little bit later, but where those transactions lie with the sort of introduction of equity crowdfunding into the Australian market in January of 2018, legislated and now sort of under the ASIC regime. We do everything from seed stage, Series A, Series B through to IPO. Deep experience of the founding team, sort of a lot of ex-investment bankers, ECM, equity capital markets, research guys, as well as sort of fund managers.
That. Could you try again?
Sorry, I've got a Siri here going on that.
Siri's always listening.
And I think the big thing here is, and we'll get into this into a moment, it's predominantly targeted at retail investors, the way the transactions have been done. Everyone to be familiar with, if you're not, sort of the institutional roadshow that a company will go on, where you go out to your sophisticated and your institutional investors for a company doing an IPO. The poor old retail investors don't get an opportunity to sit down across the boardroom table from the CEO and the chairman of that company and ask them the hard questions. We've sort of taken that mentality or that notion and decided to do that for retail investors. We do a lot of short sort of 5-minute videos that investors love because they get to see the management team presenting their company. And a lot of retail investors like that. The prospectus, if it's an IPO, the information memorandum, if it's sort of a wholesale raise, the offer document, if it's an equity crowdfunding transaction, is on the platform. People get to see that. And it's sort of been met with a lot of success, meeting both the needs of the issuers, that's the companies raising the capital, as well as at this stage, 50,000 investors who are wanting to invest in these smaller companies, taking on the risk, and obviously in many cases, in getting the reward as well when there's an exit.
Yeah. And what do you find the motivation is for those investors that have joined the platform?
The motivation, our company started out as a way to break down the sort of gated community that only has access to IPOs. And if anyone online here at the moment is invested into an IPO, you know that it's more a sort of a special exclusive invitation from your broker to invest into that IPO. We wanted to break down those barriers and open up IPOs to more retail investors. Thankfully, the ASX has continued to have that prerequisite to be an IPO company. You need to have 300 unique investors. And that's been great for retail investors in Australia. Our platform, a lot of the brokers come to us because they want to, and the companies come to us because they want a further afield than just the broking community from that one particular lead manager. They want to come to us and have a bigger group of investors coming into their IPO. And we would average around about between 150 to 200 investors into every IPO that we're involved in. We're not the lead manager, but the lead manager will raise predominantly the rump of the sizable amount of the capital, and we'll help out with a certain amount, but also bring the bulk of the investors to the party.
Yeah. So it's, I guess it's really a competitive environment for capital funding at the moment. What are some of the things that investors are looking for in businesses, in new businesses?
I think that's the next slide, isn't it? That's it. Okay. If you're a company out there, and I think as Garry sort of briefed me and Mark briefed me prior to this, if you're a company out there looking for money, this is what we would say you need to look at. We're working with, just to give you a feel for the moment, we're working with, I think it's 8 different companies across equity crowdfunding, across wholesale raises, and a couple of IPOs. We're not necessarily the main corporate advisor to an IPO company. They have their corporate advisor doing that. But for early stage companies, those that are sort of pre-seed or seed or Series A raises, our advice would be we deem it sort of investor readiness. And you need to have a good feel for what you've got in that company, in your own company, prior to going out to raising money. I'll lead with a statement that, and this may fall to a lot of the people online at the moment. A lot of the founders we see are exceptionally good at selling their product, as they should be. Where they sometimes struggle is, are they exceptionally good at selling their company? They're not used to selling their company. It's completely different sale from selling your product, selling the widget, to selling the company that it makes the widgets. So what we say is you need to be different. You need to have a point of differentiation. We would exercise that, or we would test the company on doing that by saying, come up with what we call your only statement. You are the only company in Australia that does X, or the only company in the Asia Pacific or some geographical area, the only company in this sector, the only company globally that does something. So you need to be able to lead with that statement to be able to say, we are doing something different. You need to be unique. So in the eyes of an investor, they want to invest into something that's completely brand new, or something that is solving a problem. It's the only technology that can solve that problem. Secondly, and just going down those points of the ticks on that page there,
And just
you
before
need
you
to be
go,
able to show some traction or some growth. Sorry, Garry, you were saying something?
yeah, I was just saying, just to me go that different. Sometimes what I've found with founders that they are different, but often it's actually creating some framework around how they are different. And often some founders are not comfortable with openly saying and being confident about how they are different. Sometimes that takes a bit of encouragement too, and that's where I suppose someone like yourself is, plays an important role in that space of trying to tease out those things that they're significantly different, or how they're better than the rest.
We do a lot of sort of one-on-one workshops with the companies that we help, and this is sort of let's say 4 to 6 to 8 weeks prior to a date that we would want to pencil in the diary to say, let's go out and raise capital on this date. That might be, let's call it, I know we've got Christmas and New Year coming up, but at the moment I would say to the companies we're working with that aren't raising capital at the moment, it's sort of a January 27 day, beyond Australia Day, that sort of Australia gets back to work, or 1st of February next year. And we'll sit down with these companies throughout this time, the next 2 months, fine-tuning, boiling the ocean, so to speak, around what that company has. What are your core aims? What are your aspirations? What's your traction? What's an acceptable growth for you guys at a particular stage of your company? I think the other thing to think about, if you are an early stage company, it's about, in the eyes of the investor, it's about de-risking as much as you possibly can, given the stage of where you're at, de-risking that investment for an investor. They need to be comfortable with, and I'm jumping around on this page here now, they need to be comfortable with your management team, the CEO, the credibility. You may be a 24-year-old founder. I've got one of those at the moment. And I've said to her, you need to have not necessarily a board of directors because you're sort of a seed stage raise. You need to have an advisory board around you, maybe 2 or 3 other, older, more experienced, grey hairs, for want of a better term, that are around you, advising you. And at least then an investor knows that you're open to advice. You've got older people working with you, advising you. That helps with your quality and your credibility of your management team. The other big one here is a validation that your business model actually works. And another word for that is revenue. If you're out there, we don't necessarily work with companies until they're, so we work with a seed company and onward, Series A, Series B, and then pre-IPO and IPO. It's very risky, obviously, with a much lower valuation for a company that hasn't effectively validated their business model. That's really important. Your business model's been validated. And aside from that, the other thing to look at is your go-to-market your go-to-market strategy has been validated as well. Just one final point, Mark, before we move on. A lot of investors want that market opportunity or the gap in the market. They want to be able to see that there is what they call a TAM. It's an acronym for TAM, total addressable market. That the total addressable market that you're playing in is sizable and effectively encouraging to say, I'm happy for you guys, happy to invest in the company, given that the TAM, the total addressable market, is this massive space, i.e. that we can take a certain market share of that TAM, and that market share will equal some revenue that is effectively meaningful. So that's sort of the big one there. And this is what we work on in any, just to sort of, we're going to get onto these in a moment, but what you're aiming for here is boiling the ocean of your company down to effectively a 15 to 20 page PowerPoint document or an IM that is going to be encouraging and interesting to a lot of investors on many different fronts, not just on one, but on many different fronts.
Tim, you mentioned different stages of companies, and you mentioned sort of at the seed stage, Series A, etc. Can you just explain what those different stages are and what the likely access to capital is for those?
Yeah, sure. We work with all these different stages. I know I said earlier, and you can see the light blue sort of on market bit coming in the bottom there. We do a lot of advice at the early stages. You may have an idea and you go to mum and dad, family and friends, whatever it may be, and you raise a bit of money. It's the ideation stage. This is on the far left of the screen at the moment. There's angel networks that can come in now. You may be early revenue, just sort of getting your feet wet, so to speak, and it's working out for you. That's the angels and the grants and accelerators. Where it starts to get a little bit serious, and this is the investor readiness side that we work in, you said that light blue down the bottom, is the seed round. And a seed round, you want to be able to having revenue coming through the door. Your seed round is effectively deemed to be your first major proper, for want of a better term, capital raise. We'll go through the different types of capital raising in a moment, but it's open to different ones you can do there. At the top there, that first bullet point, wholesale, crowdfunding, debt or VC funds. The size sometimes deems to be the seed round. Roughly the sort of 500 to $1 million is probably the major size. $2 million's probably a little bit big for a seed round, I would say, but we've got that in there anyway. But definitely showing growth. Definitely showing growth where you're employing a lot more people. The use of funds is important there. We haven't got that bulleted there, but what are you using your funds for? Ideally, as an investor coming in a seed round or any other later stage round, you want that use of funds to be being used for the fact that, hey, you're currently working out of an office or your distributions out of Wollongong and Sydney, but you want to expand into Queensland and Victoria, East Coast expansion. You want a new person up there driving your Queensland distribution team, whatever it might be. You want to put more money into your research and et cetera, et cetera. But you want it to be a growth story. People, investors, and going back to those other two, the slide we looked at before on investors want growth. They want to see the fact that you've actually cracked the nut in terms of what your business model is. People are coming to play, i.e. you're getting revenue, you're getting more customers, but you're constrained at the moment by the fact that you've only got 2 operatives or 3 operatives in your team. You need another 3, and that growth capital, as they call it, is going to be spent building your team out, and obviously, therefore, driving increase on month-on-month revenue. Series A and later. Series A is sort of an extension of the seed round. what can be really nice in the seed round is you can bring in a VC investor who will follow on. Same for Series A, as a VC firm may come in with a sizable check, be it 7 figures, $1 million, and they will say, listen, when you do another raise, we're obviously there for the next, we want to follow on our investment further. And that's a really good thing, because it means you don't have to start from scratch again when you're doing ladder raises. Ideally, like any investor, you want to know that there's an exit. You're not sort of putting your money in forever and a day, you're never going to get it back. You want the return. Most people are looking for, depending what stage they come in at, sort of a return within sort of 3 to 7 years would be the sort of normal horizon. And by virtue of coming in earlier, their reward is the fact that the valuation is much lower than it would be as you get further along that line to the right-hand side. As an IPO, you're probably 10 times what you're going to be valued. I'm making this up, by the way, but 10 times valued IPO stage than you would be maybe in a Series A stage or a seed round stage. So you're taking on more risk, but you're getting the reward because you're looking at a much bigger return when that exit occurs.
Just touching on some of those acronyms that you mentioned there, Tim. VC is venture capital. Yep.
What other one did I use?
And IPOs.
IPO, initial public offering. So when the company lists on an exchange, in this country it's predominantly the ASX, they go and raise sizable amounts of money. That's an exit, obviously, because it's listed. You've got a liquid market, meaning that you can buy and sell your shares on the secondary market. What we're talking about here in seed and Series A or ladder or pre-IPO is what we call the primary market, where there isn't an easy way to exit in and out of that investment.
Yep. So, and again, you touched on this a little bit earlier as to the different types of capital that's available.
Yes. So just the other acronym there is S708 or Section 708 of the Corporations Act. That means sophisticated investors. And Mark and Garry be familiar with signing that what the accountants need to sign, a sophisticated investor form that ASIC requires before we take that money. They are, I think it's a twofold test. 200, you guys might be able to help me out on this if it's changed. 250,000 in household income, or 2.5 million in gross investable assets, is it?
Yeah, that's right.
Yeah, okay. So a note is effectively a loan that you're giving, or if you're an issuer out there listening to this, a note you're taking, or you're issuing the note, you're taking capital in the form of a loan from an investor. The reason that the convertible part is it starts as debt, it converts to equity. You would negotiate in your term sheet with that investor what the predetermined conversion event might be. We've done one recently where it needed to be a raise of $2 million or more, and that would convert. You would also pay a coupon, an interest rate of around about sort of 7.5–8% or annually as interest on that loan back to the investor. Going over to the right on the debt side, I mean, most people are familiar with debt and taking that loan. The flip side now is going down to the bottom here, where you're giving away equity, and both of those only when in a convertible note, only when it converts are you giving away equity. So you're taking debt on the top two. The bottom two, if you don't want to pay, effectively interest on those loans, the other way to do it is to give equity away. Equity crowdfunding commenced in Australia. We're one of the latter countries to come on board with that. That was in January 2018. We were one of the first. There's only 7 licenses given initially. On market was one of the first to be granted a license by ASIC. So someone will come to see us. We predominantly work in the bottom two, in the light blue, the equity crowdfunding and the wholesale equity raise. And just to give you a feel, you may come to see us and say, Tim, here's our situation. We're looking to raise $1 million. We don't know whether we want to go down the crowdfunding path. We don't want to do debt or a note or an equity raise. And the question then is, can you service a loan? Do you want to increase your monthly burn rate by paying out interest to the bank, or you're happy to give away some of your equity to the investors? Doesn't cost you anything to do that. aside from raising the capital and getting investor ready. Equity crowdfunding, the difference between the left and the right at the bottom there, equity crowdfunding and a wholesale equity raise, is effectively the universe that can invest into your offer. Equity crowdfunding is, as you see there from the first bullet point, it's open to everybody in Australia from the age of 18 and above. Everyone walking down the street over the age of 18 can effectively invest in your company. One precondition on that, if you're a retail investor, you have a cap of $10,000. If you are a sophisticated investor or a Section 708 investor, we identified those before, you can invest greater than $10,000. A company can raise up to $5 million a year under that regime. And what do investors get? And this is different to, and this is the important part, you may have heard of sort of Kickstarter and Indiegogo as what we call rewards-based crowdfunding platforms. You create a widget, you effectively are getting some funding to build that widget. You offer anyone that comes in with their $100 investment or $200 investment first dibs on the widget when it gets produced. Now, this might be something that's brand new in the space. That's rewards-based crowdfunding. You don't have any equity in the company. You just get the product from the company for your investment. Equity crowdfunding is different in the sense that you put your $1,000 in and you get that equivalent $1,000, a pro rata of that in equity in the company. So you own shares in the company. It's a brilliant regime for companies that are wanting to do two things. One, create a bit of a splash by virtue of marketing and awareness out there. Two, if you've got a decent database and you've got brand advocates out there, it's a great way for offering your customers equity in your company. Which, you know, the benefits of that have been, you just have to Google that and see that. There's thousands of articles written about what it means when your customers own part of your company. Great brand advocacy, great way to increase the word of mouth when someone owns your company and what they do as a customer. We can get onto a bit more of that a bit later. On the other side, the right-hand side, the wholesale equity raise, it's limited. It's probably for a bigger raise, maybe a Series A, Series B, or a pre-IPO stage. Equity crowdfunding is really, I would say, albeit we've got one opening today, which is probably a Series B round. It's sort of your seed and Series A, somewhere in that space. Wholesale equity raises a little bit bigger. The investors tend to invest more sizable amounts, from maybe $5,000 upwards to, you know, anywhere up to $1 million, $2 million, the VC funds. There is no cap on that raise. Once again, the investors receive equity for their investment. VC funds may have a couple of conditions on that. They may want a board seat. So it's a venture capital fund, may want a board seat. They also have a mandate in their fund whereby it's reasonably, I guess, limited as to what they can invest in sometimes. It might be a different sector. You mightn't suit certain VC funds because you're in a different sector to what they want. In the next couple of slides, I'll get into sort of what people are looking for in terms of sectors and areas that your company needs to be playing around in that space.
So just on that point, I suppose the equity crowdfunding has filled that sort of void in the marketplace in some respects of allowing smaller companies to raise capital from the public.
Yes.
Whereas previously, in order to raise capital from the public, I think general proposition what mostly was put to our clients is that you need to allow about $1 million in just to have the capital to prepare all the documentation and all the reports, prepare the prospectus. You needed close to sort of $500 to $1 million to go to a public and IPO offering, and then on top of that, you needed to raise a certain amount of capital to be able to do the work you wanted to do. So it's basically there's a void in the marketplace between innovative businesses raising capital from a select number of, say, angel investors to now being able to go out to the general public. And as you say, their customers, their broader family and friends that can participate in a public offering now. And with very, sometimes very small amounts. I'm not sure what your minimum crowd equity funding is, but I've seen a lot around that $100 and $200 mark.
The the minimum amount can be $50. The average is probably the $250 to $500 as the minimum parcel size. The other thing I'll add to that, and this is probably an important one, any investor that invests under the crowdfunding regime is exempt from the 50 investor cap. So that's an important one. So a lot of companies, they might, but you might already be at 20 or 30 shareholders. If you go down the equity crowdfunding path, anyone that comes into that under that crowdfunding regime, under that investment, is exempt from that 50 shareholder cap. So it's a good way to raise money without sort of increasing the number of shareholders from that side of things. It's been very successful in other countries, predominantly the UK, where they're doing hundreds of these a year. There's another slide coming up where we can get into a bit more detail on that a bit later.
So I guess from what I'm hearing at the moment, it's not just simple for a business owner with an idea just to go out to the market and ask for money. What are some of the things they need to consider, I guess, at the business level when they're approaching investors?
Yeah, so this is the mindset is a good one. We call it investor readiness. You can't say 1 week, and if you're sitting there right now thinking I need to raise money, and you're thinking, I can do that in the next 2 weeks, I can just start going out and tapping people and knocking on the door, or going to my network or my customers, my suppliers, wherever it might be, and raise money. You want to treat this, not that you're not treating it seriously, but you want to give it sort of time to really prepare yourself properly. And there's a couple of lists coming up in the next couple of slides, but you want to have your ducks in a row, for want of a better term. And that is, you need to have a budget initially. Yes, some of your costs, and we sort of look at this as well, will be charged out of success fee of raising money for you. But you need a bit of a budget just in terms of to get everything ready. If you're going down the crowdfunding path, it's somewhere between sort of $10,000 to $20,000 to get yourself set up properly. Putting together an offer document, putting together a crowdfunding video. If you're going down the wholesale path to the 708 investors, you need to have a really good IM, investment memorandum, or information memorandum. You need to know, and this part 2 here, sort of as I mentioned earlier, what is your use of funds? Where are you at? What are the strategies that have worked for you? You need to talk about not selling your company and selling your product anymore, you're selling your company. If you don't know where you're going on that, what is the size of the market you're playing in, the total addressable market, your due diligence, and that's part 3 there. Any company that's putting in a sizable amount, it's probably none of the crowdfunding stuff, but we'll do this for you. What are your significant contracts you've got? Have you got those contracts there effectively in a data room or somewhere that I can see them? If an investor wants to ask for, I need to do my due diligence on, you say you're doing this, I need to be able to see that. And that's what due diligence is. Just mirroring up or reconciling the fact that you say you're doing one thing, on the other side, you need to show me the evidence that's actually true. And that may be if you've got patents or patent applications, you need to be able to line all that up as well. Employee contracts, significant supplier contracts, all of those things need to be sort of at the ready. And that may take, for an unorganized company, that will take a while. For an organized company, listen, that's a next day thing. But you see a lot of different founders who, there's a lot to take on as a founder. I'm a co-founder as well. There's a lot to put together, and different skill sets suit different people, and sometimes compliance and getting all that investor readiness stuff doesn't suit some people. They might be the marketing creative side that, I'm more that side. I'm not necessarily good on having documentation there at the ready when someone wants it. On the right-hand side there, as Mark and Garry sort of talked about, I think already, and I can give a couple of case studies on this as we go through it. At the moment, given COVID and given sort of everything shut down for us and for everyone raising capital between sort of April and let's say July this year, it is hot at the moment in terms of companies wanting money, understandably. There's hundreds of companies out there at the moment raising money. if you own a house and you're in the real estate game, you'll understand the difference between a buyer's market and a seller's market. At the moment, it is, without a shadow of a doubt, a buyer's market. It's like a beauty parade out there for a lot of these venture capital companies and sophisticated investors, seeing all these companies out there parading around wanting money. And getting back to, I think, the third or second slide there that we're talking about, you need to stand out. You need to have a way to stand out in terms of differentiating yourself from your competition, or being something that jumps off the page when, the 10th email today, as I'm sitting there as a VC director, the 10th email today comes in saying, raising money, here's my PowerPoint slide or slides. That needs to jump off the page for somebody to say, hey, let's have a meeting. I think that's probably the most important thing. The other side of that is, and everyone will say this to you as a founder, as a company wanting to raise money, it's patience. It's going to take longer at the moment than what we've seen before, and that's proving to be the case with us. We've been out with, I think, 4 companies since September, now end of November. We're still struggling in some cases. Others are going okay, but it's been a challenge to get the attention that we're getting, say, this time last year.
And then, just to say, following on from that, Tim, some of those things, specific things that you need to prepare yourself to be ready.
This is what I was alluding to before, sort of a checklist of things to have, what we call in a data room. A data room is effectively a fancy way of saying you've got a file there that is password permission that you can share with a potential investor that would highlight all of the things that they wanted to look at. This isn't necessarily down the crowdfunding path. Someone coming in and investing $1,000 in your company doesn't need to see this. But if someone who's looking at, let's say a 6-figure amount, may want to say, listen, can I have a look at your shareholders agreement or your constitution? I'd love to see your financials for the last 2 years, audited or unaudited, or at least signed off. What's your capital structure look like? I'll give you an example. We're working with a company at the moment who only, last week we said, listen, let's go out this week with your raise. How many shares have you got on issue? I've got 10 shares on issue worth $1.4 million each. It's like, well, we need to change the capital structure around. We need to have a share split done with ASIC. So you need to get all that stuff done where you're issuing a whole heap of shares split down to $1. So when you're going to raise capital, you haven't got each share worth 1.4 million. The thing that's going to take the longest for you, if everything's sort of, running along and you can put your hand on a lot of those things. Yes, I've got good financials. Yes, I've got a constitution or shareholders agreement. Yes, we're very good at planning and we do know our business strategy. We have revenue. It's working. I know what my go-to-market strategy is. I know what my business model is. I can easily, change that. I can show that, given the last 6 months, I've pivoted due to COVID. We're now a COVID beneficial business or a COVID agnostic business. You don't want to be raising capital where you haven't got a clear strategy or page in your IM or your offer document that talks about how you're dealing with COVID and how you're benefiting from COVID. That 5th point there, the detailed pitch deck or investor video, they'll take the longest thing to work out. And that's where you need to really showcase your point of differentiation. You boil that pitch deck or that video down even further to, and this is the next point, the 6th point there, down to maybe 3, maximum 4 key messages or value propositions that are going to entice an investor to come in. And that's where we help out with sort of, the copywriting. We've got a deal going live this morning. It's a medicinal cannabis company raising 2.5 million. This is a crowdfunding campaign. It's taken us, I'd say, 6 weeks to help them with their pitch deck and with their investor video. And we have boiled down their key messaging down to certain things. Down to 3 or 4 different value propositions that are going to go out to investors to entice the investor just to get to their offer page to then look at some more details on that company. What does the offer page do? The offer page then entices that investor to watch their video, maybe potentially read their pitch deck, depending on their level of investment. And then ultimately, bid or make an investment into that company. The data room is predominantly for wholesale and VC or venture capital private equity investors. This is the list, thank you, Mark. This is a list of things you want in that data room. We're looking here at the middle section, setup of data room part B, your business plan, your ASIC company registration, your IP if you've got patents or trademarks or certifications. Obviously, your corporate structure, we ran through a little list before. Your financial model with forecasts. You can't put forecasts into your equity crowdfunding offer document. You can into your wholesale raise, but that's where you put it. Your shareholder register. I'm interested to know who's on your shareholder register, what percentage they own. That's a key part. Some idea then around your key contracts, employment, manufacturing. It's all on there. And then the key one there is, listen, what is your monthly recurring revenue, your annual recurring revenue? At the moment, it might be X, but you know what? In 6 months' time, we've got this much in our pipeline. We see that growing to, X plus, a couple of $100,000 on top of that. The other one there is, who's on your board, what's their experience, and people will take great comfort in the fact, as I mentioned before, that if you're a younger founder, you want to be having other people around there who have done it before. Yes, they like the young founders, ideas and way they can see the gap in the market and want to go for it. But they also want that founder to have some level of experience sitting around them.
I guess just turning to you, Garry, for a moment, you've been through a lot of this process with the residents, some of which are our clients out at the Innovation Campus through the iAccelerate program. How have you what's their experience been like, I guess?
Yeah, look, and the residents at iAccelerate have used a variety of different means of raising capital. Certainly crowdfunding has been some of it. A lot of them are in that angel investor stage. And whether you're at the angel investor stage or crowdfunding or seed capital raising, having access to those documents are all really important. The same process and procedures apply, whether it be looking for equity crowdfunding or angel investment capital. One thing I've seen that Tim's probably skipped over, and some of the things that I see that they bring in as value to the equation is that consistently I've seen with clients that Tim's worked with our clients, is there's a mentoring process in the background that happens in preparing the founders for the crowdfunding equity raise, down to things like the early initial conversation to say, look, how much capital do you need? What do you need to spend it on? If you need to raise $250,000, you'll need to make sure that we've got about 100,000 of that secured up front with family, friends, etc. Because what we want to do is once we go to an equity crowdfund raise, we want to have some momentum to the extent that if we're going to raise 250, you want to have some degree of comfort. Now you've got about 100 of that secured straight away, and then you go to the open market to raise the other 150. So you've actually got momentum when you go to market. Now, that's the sort of thing that Tim does a lot of work with our clients in regard to mentoring the clients, making sure the documents are prepared, having the resources to assist them in the areas that they have gaps in. And that's where I see that there's a lot of value. And that's consistently applied sort of at the resident at iAccelerate, the residents at iAccelerate, and the work that Tim's done with some of those clients.
And I guess the other thing that businesses that are looking to access funding need to consider is it's not just going to be their business anymore. They're actually sharing or giving away part of their business to other investors who have sometimes different motivations to what the initial founders have.
Yeah, absolutely. And we've had similar experiences more recently in regard to different examples of that where people shared equity in their company and then realize they're then accountable to those shareholders. And that's important, and things that I'll talk a bit further later about is recognizing what your responsibilities are to investors, identifying up front with investors as how often you will report to them, not only from the point of view of creating an obligation for yourself, but making it quite clear to investors what your obligations to them are, so that it's managing their expectations. And that's some of the sort of things that we do a lot of work with clients in regard to the types of reports they'll need to provide to investors, whether they be formalised corporations reports. One of the things that we would actively encourage with even founders at lots of different stages or early stage investment, or even through equity crowdfunding, is to do investor briefings. Sometimes, depending on the speed at which the company is developing, whether they be monthly or quarterly. So they're not necessarily something that would be required by corporations law, but something you'd want to actively encourage with the company to build the relationship with its investors.
Yeah, we just to add to that, Gary, first thing, a lot of people get scared off by crowdfunding because it's like, taking on another 250 shareholders here. Obviously, we encourage that you subscribe to a shareholder register, a computer share or a link or an atomic to run that for you. And then we encourage that probably quarterly, more than monthly, just a quarterly update to those investors around what you're doing, what your aspirations are, looking back on terms of what you've achieved, keeping those investors in the loop, because no doubt you're going to be raising money again, and these shareholders will obviously want to see a bit of an uplift in the valuation, but at the same time they follow their money as well.
We've spoken a lot about crowdfunding today,
Yes, yeah.
and it's, as you mentioned, it's relatively a new, source of funds in the market. Is it getting traction in the market?
Yeah. Thanks, Mark. Well, this is a snapshot of the last 2.5 years. As I mentioned, it started in Australia in January 2018. And this is effectively the whole Australian market up to, I think it was about July this year. So 114 offers have gone out. Some have failed. You set a minimum and a maximum target as the company. If you don't reach your minimum target, let's say that might be you set a target of a minimum of 300,000 and a maximum of $1 million. If you don't in the time that you've set for yourself, you set a start date and you set a close date. It's a maximum time of 90 days. You can choose anything shorter than that. Obviously, we choose much shorter, and things get a bit stale after 3 months. So you want to do something around about sort of a 4 to 5 week campaign. I encourage you after this just to go on Market's website, just on market.com.au, and you'll see one that's gone live today. It's called Canatrek. You'll see a start date and a close date, and you'll see some of the funds they've raised already. The success rate, to be unsuccessful, it means you haven't raised the amount of money, the minimum amount by the close date that you set for yourself. I think the big one here is the median is 442K. The average is around about, I think, 550 to 600K in terms of the success of the raises. Largest one was done last year, $3 million for Sheba, which is effectively female drivers for female passengers Uber service, or similar to an Uber service out of Melbourne. And then we did the largest one actually, which was very early on in 2018 for a company called DC Power, nearly 15,000 investors. Average number of investors coming in, that's very high, but the average number of investors you'll see coming in somewhere around the 400 shareholder mark, 300 to 400 shareholder mark. And it's resonating, and the reason we like it, not to say that we do majority of raises in crowdfunding, we don't. We do a lot of wholesale, and we do a lot of pre-IPO and IPO raises. The reason it works really well, crowdfunding, is it doesn't stop the wholesale investors coming in. So you get the best of both worlds. You get the retail investors at the shorter end or the smaller end for your $500 investment. They might be your family and friends. That might be your smaller customers who will come in because they really like you and they like what you're doing, and they say, happy to help you out. I necessarily won't get into looking at your offer document in fine detail, But then at the same time, you can also get the $100,000 investor coming in because they really like what you're doing. And they will want to, and they have access to, you just doing what we're doing now, a quick webinar or a quick face-to-face Zoom call with that $100,000 investor who gets to feel and understand you and know what's going on, and feel comforted that the 100K that's not a problem. Happy to do that. Really like what you're doing. What's worked best for us on our platform? This is a bit of a snapshot of the 160 odd transactions we've done. If you don't fit into this part, it doesn't mean it won't work, but I'm just saying that a consumer-focused company, something that's selling necessarily a B2C product, that's a business-to-consumer product, has worked really well for us, especially in crowdfunding, because you can get it, you understand what it is they're selling, you understand the business model. So something where you're easily transferring what's in your mind, what's on your company's strategy document, into an investment memorandum, into an offer document that a consumer can easily understand what you're doing. I get it rather than I don't get it. A lot of investors will only invest in things that they understand. That's consumer focused. We've had nearly 20,000 investors bids, that's people bidding into those companies throughout the last couple of years. The other one, which is hot, which is no surprise to anybody here, is technology, especially with COVID. Technology is massive. That is obviously an improvement on the way things are done by virtue of an improvement in technology. The big one at the moment is the revenue model for technology. How are you making money as a company with a technology company? Is it a SaaS model? That's an acronym for software as a service. So it's a software model whereby I subscribe to it, Garry and Mark subscribe to it and pay X amount per month to be a subscriber. A lot of companies, a lot of VC companies come to us and say, Tim, I like this one. Effectively, I've just done a deal in the US or the UK and I can flick a switch and without too much more capital expenditure or operational expenditure, I'm live in 50 states in America with a flick of a switch. I've got my distribution guys over there. It hasn't cost me much anymore. That's a really scalable technology. Investors love scalable technology as opposed to, let's say, a hardware as a service. Hardware as a service, there's a turnaround time to get something set up. There's a capital expenditure to build that hardware each particular time for a customer. So there's different ways to cut and dice it. But they're the two big ones that we're seeing a lot of success with. Not to say that if you don't fall into that, there's no hope for you. There is, because then you look at the right-hand side. These are the things we've sort of been through this before in one of the earlier slides. But it is, and I stress again, what is your difference? Being able to articulate and show your traction and growth in some sort of bar chart that so month on month, here's what we're doing, we're growing revenue, or our traction is, and I use this term a lot, I've targeted a massive domino in my market who's going to be my customer. When you get that customer, that domino signed up and it falls, that will lead to other customers in that space coming online again. And that's effectively your pipeline that you're showing to a potential investor as to what you're doing. That also leads to, and those 2 points can be flipped around a bit, the next point, which is by virtue of having traction, you're getting revenue. By virtue of having revenue, you've got traction, and it's a validation that your business model works. And I can't stress that point enough. If you come to us and say, listen, I've got a bit of revenue, but it's a bit lumpy. Have I truly got validation that your business model works, or does it need to be tweaked and pivoted and fine-tuned before we go live? We will, and Garry was talking about this before, we do a lot of mentoring. I worked with one particular company from iAccelerate over the last year, but just I had to say to them, listen guys, it's too early on for you to go out and raise capital. You need to wait another 6 months. You need more traction. You need more revenue in order to do that. And by virtue of having more traction and more revenue, the thing we haven't got on there is, and this is the variable, is your valuation. Your valuation is a combination of numerous different things. And people talk about science and art when it comes to valuation. In the early stages that a lot of you guys are sitting at, in early stage companies, there is no science, because the science is based on a multiple of your revenue or a multiple of your EBIT or whatever it might be. In this stage, there's a lot of art involved in it in terms of, hey, how much are we worth? It's hard to determine, but the more you have revenue validation and traction, the higher and easier it is to validate your valuation at a higher level based on your track record over the last 6 to 12 months. But if you're coming in January of this year as opposed to November this year, you would hope that your valuation right now in November is much higher than it was in January by virtue of your revenue, your customer base, your big contracts that you've signed coming on board in the last 10 months as opposed to what it was in January. And it's a really important one to have. If you're going down the crowdfunding path, this isn't essential, but it is, as it's mentioned there, it's beneficial. And Garry mentioned this before. Before we go live, and you'll see this one today, if you go onto our website and have a look at Canatrek, you'll see a funding bar across the screen. Their target is 2.5 million. Their minimum was 500,000. And this is a live case study example for you to think about. And if you are thinking about raising money, just follow that funding bar over the next 2 weeks because you'll learn a little bit about how we operate and what happens. What we do is, and this is us, and I'll be honest with this, we followed Crowdcube, who are the biggest crowdfunding intermediary in the world, platform in the world, out of London. They started up in 2012, remembering we started up in 2018. We were given effectively about 9 months by ASIC to say, listen, you need to have your license submitted to us by, I think it was October 2017, and we were granted the license in January 2018. So we had about 6 to 9 months to do what we did was what was called a deep dive on the different crowdfunding platforms around the world, remembering that UK and US were 5 years ahead of us. What are they doing well? What are they doing not so well? What will our business model be for crowdfunding? What Crowdcube do and what we've emulated is you have a private audience, a private period in your crowdfunding raise, whereby it's a period of probably about 7 to 10 days, whereby you go to your family and friends, you go to your network, we go to what we call those who have expressed interest in your campaign, and we raise a certain amount of money. Roughly, we want to hit a target around 30% of your minimum target, so that when we do go to the public, like we've done with Canatrek today, we're going to 53,000 an email in about an hour and a half, and we'll show that. And you guys are a good test. If something's trying to raise 2.5 million and it's sitting there like it is now at about 860,000 already committed, it's going to be a little bit of FOMO. You're going to get validation and sort of feel some confidence that that company is going really well and the crowdfund's going really well, as opposed to going out, if we call this day one, with 0 in the book, and you go out with an email and the funding bar sits at 1% as opposed to sitting at the moment and gets, because it's over the minimum, it's around about 80%, it's around about 120%. That gives confidence to investors for the crowd to follow other people in the crowd. You always feel very comfortable investing alongside others, particularly others who are smarter than you because you think that they know better, and in most cases they do. That's the strategy we work upon in relation to taking your campaign, building an early base of private investors, i.e. your cornerstone investors that are going to get your deal off the mark and get your funding bar sort of going in the right direction before you go to the big crowd. They're releasing a press release this morning. The press will go on and see that sitting there at sort of a sizable 900, will hit $1 million today in terms of funding. The press will report on that. That'll be in tomorrow's paper. So it's about building momentum. And this is where sort of I come in. This is my strength in terms of the campaign management of your campaign over the next 3 weeks. If they're closing on December 15, managing that campaign over the next 3 weeks and making sure that you're pulling all the right levers out of the playbook to maximize exposure and to maximize effectively converting let's say a potential investor into an investor.
Yeah, that's really interesting, and I'd encourage people to go to the website. It's something I'll be doing afterwards, and just checking to see how that capital raise goes over the next couple of weeks.
Yeah, so they have, and just to sort of elaborate, for another 30 seconds on that, we set up, you'll see it there, a landing page, which is effectively your IM, but boiled down into something that is your own landing page. You've got your own website. It has on there your offer document. It has your video. It has all the press in relation to your company. It has your company constitution, your shareholder agreement, all the things there that a diligenced investor, and there's two types of investors here that are investing in your company, especially when it comes to crowdfunding. There's the retail investor, wants to put in $500 up to $1,000. They just like it. They like whatever company you're doing. They're not going to get into the nitty gritty of your shareholder constitution, whatever it might be. They're going to put in their $250. Then you've got a target, and you've got to speak. This page has got to speak to both audiences. Then you're going to target the 10,000. Well, let's say the $5,000 and above investor, who will be diligenced, who wants to see your contracts, who wants to know what's going on, who wants to know your business model, your total addressable market, and that'll all be sitting there in your offer document, in your company constitution, in your business model, et cetera, et cetera. Now, the other side of that is, even if you do a wholesale raise, we still have a landing page for you that people will come into. So we settle that up. It's the digital way of raising capital these days. It's all sitting there for you as a potential issuer wanting to entice investors into your company.
Just turning to you, Garry, for a second. I guess capital raising is one part of accessing capital. And we've spoke over the last couple of weeks about some of the other other assistance and grant funding that's out there.
Yeah, sure, Mark. And I think one of the things we did talk about at one of the earlier presentations when Peter Marston talked about grant funding is how to dovetail that into other funding. And that equally applies in regard to crowd and equity crowdfunding generally, is it's important to consider that in conjunction with the other funding that's available, both in regard to both federal government, state government grants, the R&D incentive, the various different tax incentives that are around at the moment, the apprenticeship subsidies. All of that's going to be built around raising a certain amount of capital. So it might be, and these are typical sort of examples that we've often seen, is the company might think, well, I need $250,000. Often we have a conversation with Tim and we realise that the company doesn't need $250,000, they need $500,000. So then there's a rush around and think, well, where are we going to raise $500,000 from? Then we backtrack back and say, well, of that $500,000, once we allow for all the incentives that might be available, whether it be grant funding, business tax incentives, what they really still need is only $250,000 from the marketplace, of which they might already have $100,000 from closely held family members, etc., or people who have previously invested in them in earlier stages. So what they then need to do is raise $150,000, $250,000 from, say, an equity crowdfunding raise. So it's probably what I'm highlighting there is it's actually important to look at the raising of capital in conjunction with the company's business plan about what they're looking to achieve. Then sit back and look at what are the variety of different sources of funding that are required. So when they come to the stage where they're talking to Tim, they've got a clear strategy in mind. Now, if that hasn't been done, Tim and myself and other advisors will still lead them through that process. There's a certain amount of work that founders can do themselves. And what I've done is I've done a bit of a list of those things, a bit of a checklist of the areas that people might consider in addition to doing an equity crowdfund raise. The next sort of slide, I talked to, this is probably looking at the fundraising from the investor's perspective. And the reason I do suggest that it's not only relevant if you're an investor, but also if you're a founder and you're looking to raise capital, as these are the typical sort of things that investors are looking for and considering when they're looking to raise capital. They're going to undertake some sort of due diligence process. As Tim sort of highlighted, is that, you know, if you're investing $250 or $500, your due diligence is probably going to be not that significant in the sense that you're probably investing the money at that level because you've just got interest either in the individuals or the company or the industry that they're based in, or you might be a customer. Certainly if you're investing more than $5,000, $10,000, $20,000, you're going to do a little more due diligence. And as you step up the amount of investment, then, and depending on your level of experience in regard to investing in private companies, your due diligence is going to step up accordingly. And you're probably going to expect that the company will provide you more detailed information because you're putting more capital up front. So if the investor's going to do a certain amount of due diligence, I also make it clear to investors that are looking to invest in startup companies that you should only invest money you can afford to lose. It's not, often people would ask the question, how much of my total investment capital should I invest in startups? My general philosophy is that you shouldn't probably invest any more than 5%, maybe 10% at tops, but you shouldn't invest anything you can't afford to lose, because the reality is investment in startups is high risk. And you want to make sure that if the company does fold, that it's money you can't afford to lose. It's not money that you want to be putting aside that you would otherwise quarantine aside for, say, retirement purposes. The investors probably should always clarify the relationship and the commitment they're making with the company, particularly if you're an early stage angel investor. Make it quite clear that you're either just putting money up or that you're prepared to make other commitments in regard to mentoring those founders, attending directors' meetings if you're appointed as a director as an early stage investor. But just make quite clear up front so there's no misunderstanding. Investors should always consider the market, paying the market price, and that sounds fairly simplistic, but I often see that there's a reasonable amount of emotion that investors are involved in the early stage investment, and that often means they often pay a price that's higher than the market value, and that then can only lead to disappointment in the future when they're looking to exit, and they may not get the capital return that they would otherwise have anticipated if they hadn't paid above market price. Preparing term sheets is really important. That's both from the investors and the founders' point of view, making quite clear about what the terms of investment are. Now that's the equity crowdfunding documentation makes it quite clear when you're investing what you're getting for your investment, all those sort of things. When you're doing investment prior to equity crowdfunding, as an angel investor or an early stage seed investor, often you got to make quite clear, things like who are you investing in, who's going to own your investment, how much capital you're putting in, what are the terms you're putting in? Are you putting in as a convertible note, or are you putting in as buying equity up front? How much capital you're going to put initially in, how much you might want to put in over a period of time. So a whole range of things that clarify. And a lot of times that sounds quite simplistic. Like if you buy a product, you know what the price is, you know the product you're getting. When it comes down to investing in companies, there's a bit more complex than that. And it's not only based upon the key terms about what you're paying, but also what you're getting, but it's also the conditions based around that sale. If you've got buying shares, when can you sell those shares? Those sort of things going forward. And I'd always insist that often people prepare a term sheet, but they don't insist upon other legal documents being prepared, like having shareholder agreements. I'd always actively encourage that. It's important to formalise the relationship between the founder and the investor. As I mentioned before, it's really important for the investor to clarify with the founders of the company what the expectation is in regard to reporting. Will they get a monthly report, a quarterly report? And I agree with Tim that most of the companies at this stage, they would generally be preparing sort of quarterly shareholder type briefings. There's generally an obligation in the corporations law that if you're an investor in a company, you would get an annual report, which is like once a year. But certainly the founders that are actively engaged with their shareholders, giving some sort of feedback, sometimes largely operational or future market developments or wins that the company's experienced. And that's what the sort of the information they're sharing with shareholders in that early stage. I think it's important for investors to make quite clear, particularly if you're an early stage investor, what your investment horizon is. So make quite clear with the founders to say, my expectation is that I'll exit out of this company between 5 and 10 years, or whatever that time frame is, so that the founder can give you some feedback straight away, whether that's realistic or not. It's really important to have open communication, particularly, as I said, when you're an early stage investor. I don't actively encourage first-time investors, particularly, just to invest in industries they know and also those that they can add value to, meaning that there might be, it might be a mining innovation. Well, if you're a mining engineer, that's a typical sort of investment you might have an interest in, because not only do you understand the industry, but you potentially can bring other added value. And one of the things I did, point at the last point that I made there is, when you're investing as an early stage investor, try to avoid just investing for money. Often what founders require from the early stage investors is, experience, that grey hair in the room that Tim's mentioned already, some expertise, but also networks in the industry. If you're a mining engineer and you're teaming up with a founder that's developed some mining technology, those networks in the mining industry that mine engineer brings will be invaluable in connecting with the right resources, whether they be potentially future customers or potentially also future investors. And finally, as I said, that start small, invest. If you're an early, first-time investor, invest $1,000 to $10,000, then potentially scale up in that investment if you wanted to, and then finally, invest in the founders, meaning be prepared to mentor them, work with them if you're an early stage investor. Okay. So I think they're probably the main things. And as I was pointed out, is that it's about highlighting not only they're the tips for first-time investors, but also that they're the sort of things that founders need to consider when they're contemplating what their investors are thinking, because that's typical sort of things that the investors are looking out for.
All right, thanks, Gary. We're running over time, so we might leave it there. I really would like to thank Tim for joining us today. As I said earlier, this equity raising is not something that I've had a lot of experience or exposure to, and I really found today's session really beneficial. And I'm sure that our attendees and those that go and watch the replay of the webinar on our website will also get a lot out of the presentation. So thanks again, Tim. Tim's contact details are there on the screen, and certainly would encourage you to go to the website and follow these raises that are happening at the moment. So that's the final presentation for 2020. Thank you to everyone that's contributed over the last 10 weeks in relation to our series of webinars. I would like to thank our presenters, Ian Jervis from Paradigm Home Finance, Nathan Harper from Finlert, Ryan Bradbury, Nichols and Bryan, Mick Donoghue from Capstone Marketing, and also special shout out to Mick for producing all the videos and the invites and all the behind the scenes work that he does in making these webinars happen. Amy Harper from Kells, Peter Masterton from Oz Industry, Tony Bates from Blue Point, and today Tim Eisenhauer from On Market. So thank you to all our external presenters. Thanks to Nick Fitzgerald, Angela Hales, and also Garry from Accounting Professionals for your contribution to the webinar series from a presenting point of view. Also, the team that works behind the scenes in the office that makes all of this happen, often at short notice. So thanks to Garry, Debbie, Jess, Erin, and Lynette for all their work that they do in relation to making these things happen. Lastly, I'd just like to wish everyone a happy Christmas and a safe new year. Enjoy the break after what's been a difficult at times 2020, and we look forward to catching up with everyone in the new year. So thanks everyone for joining, and see you next year.